Hello. Thanks to Dean Armstrong for recording the first part of this webinar. Dean, as you will know from looking up his profile, is a genuine accredited expert who spends most of his professional life dealing with cryptocurrencies and issues around that, crypto assets. So from turning from him as a real professional in the area, you're now going to hear from somebody who's more of a gentleman amateur in terms of cryptocurrencies. I'm a family lawyer who has done a number of cases involving cryptocurrencies and have had to learn on the job a great deal more about them than I did know a year or two ago. And so with that caveat that I'm not an expert in cryptocurrencies, but a family lawyer, I am still going to give you, or endeavor to give you, a little bit of an introduction to what I have learned from my experience of these cases over the last few years, and some of the particular pitfalls and challenges that cryptocurrencies present for family lawyers in particular. So position we should probably start with is just to recap on some of the issues that Dean introduced us to in his talk. Crypto assets and smart contracts that I'm not really going to talk about in any detail, but we'll just touch on briefly, are, we still say probably, but now almost certainly in the light of the RIAA decision that the Dean spoke about, considered to be relevant property. And I mean relevant property for the purposes of divorce proceedings, and indeed the legal statement from the Joint Task Force, the link to which I put on the screen there, gave huge amounts of support to that. So anybody seeking to argue that this is not property in the conventional sense and then therefore in some ways not disclosable is almost certainly wrong and is likely to be given a short shrift by the family courts in the light of the general approach which the judiciary are taking in this area. So we have to work on the basis that anybody who has crypto assets has assets which are disclosable in financial remedy proceedings, and they are clearly therefore property which can be made subject to property adjustment orders and indeed orders for sale to be dealt with in the usual way. An important feature to bear in mind when we come to the issue of division is that a crypto asset, in most terms, there may be some exceptions, but generally speaking, cryptocurrencies can be almost endlessly subdivided. The code from which they are created allows them to be subdivided almost to an infinite number of decimal places. So, for example, somebody who has a number of Bitcoin can have an order that they are divided to as many as 8 or 10 or even 15 or 50 decimal places, depending on the circumstances and indeed the value, because there clearly comes a point where you're dividing sub decimal places of a penny even. Which makes it disproportionate to do so. But it's important to bear that in mind, that there's almost no limit to how many decimal places an asset can be divided to. And indeed, because Bitcoin and other currencies can be used as a currency, and indeed some retailers and some tradespeople will accept them, there's no reason why in theory you can't buy a cup of tea with what at today's price would be something in the region of 0.000422727 Bitcoin, for example. So that's an important feature to bear in mind, particularly with cryptocurrencies. So the nature of cryptocurrency is a form of property, but it's very important to remember that it is an entirely digital asset, is entirely virtual and intangible. And that will create for the family lawyer a number of difficulties because it differs in many respects from the type of property that we're more used to dealing with. And one of the key issues that arises, there's no conventional register of ownership, and it can therefore be difficult to trace these assets. Most cryptocurrencies exist simply as a link in the blockchain. There's usually going to be a public key in the case of most popular cryptocurrencies such as Bitcoin, such as Ethereum. The public register is always linked to a private key, and the private key is really what is key to the ownership of that particular bit of currency, because although everybody can see on the public register that an element of Bitcoin exists, so the public register will show you how many of those crypto assets exist in circulation, but it won't show you who the owner is. The only way to prove ownership is to show that you hold the corresponding private key to a part of that blockchain, that segment of the blockchain, which equates to the currency which you hold. And so the person who holds the private key ledger is the person who has control of the asset. And that's really very, very important to understand, because what flows from that is that ownership will generally be anonymous. So compare that to ownership of land or companies, where even if it's done through a number of other entities, ultimately there is a register of ownership which can be inspected. That can't be done with most crypto assets. And we can include within that smart contracts, which are forms of contracts, bilateral or multilateral, between one, two, or a number of individuals, which are entirely conditioned and linked to a blockchain transaction as well. So the contract itself is held in the blockchain. And indeed, you can make a contract with somebody, quite why you'd want to do it, maybe as a matter for conjecture. You can make a contract with somebody which is entirely anonymous. So you don't know who it is you're contracting with. You have simply contracted with somebody else who is also on the same blockchain that you are contracting with. Now that creates all sorts of issues of tracing and difficulty in relation to the assets. So going back to the importance of understanding who holds the private key and the critical nature of the private key to the ownership of the asset, it's important to understand, as Dean explained a little earlier, how the private key can be stored. Now, the private key in the context of most forms of cryptocurrency, Bitcoin, for example, Ethereum, is simply a line of code, a number of letters and numbers in a sequence which is unique to that particular element of the key. And that can be stored in a number of ways. In its most simple form, it can simply be memorized. The only place it can exist, potentially, is in the head of the person who has created that little chunk and received the section of private key code that corresponds to the part of the blockchain public code that gives them the ownership of the asset. And they may simply have memorized it from the screen when they saw it and then destroyed any other record of it. So long as they have a memory of it, they can use it to access the register and trade that element of cryptocurrency which they hold, which of course makes it very, very difficult to trace, and also makes it very difficult to bring it back if you forget what the code is, because that's the other important feature. If you lose the private key, you lose access to the asset. The asset will still exist, but you will no longer have it. It's a little bit like dropping a gold coin to the bottom of the ocean. It is much lost to most of the world, and although it still exists, it isn't actually retrievable by anybody. So relatively few people are going to store a long 30 or 40 letter or number list of private key codes purely mentally. So the alternatives are to store it in other places. People may just write it down. Again, unlikely that many people will do that. Most people will store it either on a cold storage facility, or they'll store it on an exchange. Now, what do we mean by cold storage? Well, cold storage simply means, in the vernacular that the cryptocurrency industry has developed, an offline mode of storage. So it's likely to be a memory stick or some other USB device or other kind of memory device, maybe even a hard drive, where the codes are retained, but they are not connected to the internet and therefore are held purely by the person who has the physical device on which they're stored. Now that contrasts to what many investors in cryptocurrencies will do, which is that they will store their private coins on an exchange. And an exchange means a commercial provider of a service which allows people to buy and trade cryptocurrencies, and as part of the service they provide, they will retain within a wallet which they manage the individual private keys for each person who buys and sells on their site. We'll go on in due course just to explore how those different options creates difficulty for the family lawyer, but you can see immediately anybody who is keeping everything offline makes it very difficult for you to necessarily identify what they hold and indeed to pin down where those holdings might be. And then the final point to raise, and again Dean mentioned this earlier on, is that these are assets which are likely to be very difficult to value, and they may also have a huge amount of volatility and be quite unstable. So any value you pick at any particular point in the day even may change significantly to another point in that very same day, never mind from week to week or from month to month. We then also need to think about tech businesses, which is a whole further layer of complexity over and above crypto assets generally. We clearly are so far been talking mainly about cryptocurrencies, Bitcoin, Ethereum, Litecoin. There are very, very many different currencies around there, as I'll discuss in a moment. But there are a large number of people now who are trying to use blockchain technology to create technical businesses, particularly in the financial technology sector. And the valuation of businesses that are in that area is particularly difficult and challenging. And just as an example of how many people there are out there who may be trying this sort of thing, I did look on Companies House statistics a while ago and saw that in 2018, which is the last year that figures are currently available, recording this in the early parts of 2020, so the 2019 figures aren't yet available. But in 2018, there were nearly 12,000 software development and programming businesses incorporated in the UK. Now, they will include people who aren't in the cryptocurrency sector, as well as those who are, because they may well be web designers and people like that in that sector. But a significant number of those companies will be individuals who are trying to exploit blockchain technology for what could potentially be very lucrative financial transactions. And even the year before, there were 10,500, so a growth year on year of about 2,000 incorporations of that nature. Now, of those, about half fail within about 5 years. That's the long-term average of success in this sector. But there are always the prospect that within those 12,000 or so being incorporated every year, there are one or two unicorns, those businesses that start with a effectively minimal valuation, but are then able to be floated for a price of £1 billion or $1 billion or more. They are relatively rare, as we all know, but there is always the prospect that the one that a husband or a wife is developing in a particular divorce may turn into one of those unicorns. How do you deal with those? Well, we'll discuss that in a little bit more detail later on through some case studies that I'm going to talk you through. So, bringing all of that together, all of this presents some real challenges for the litigation lawyer, the family litigation lawyer. First is going to be identifying and or tracing the asset. Secondly is having identified the asset, considering how you go about protecting it during the interim phases of the proceedings. There's then the practicalities of how you value it, which we'll touch on in a bit more detail. And then there are also the practicalities of how you actually realize the value of the asset and how you might transfer the value of the asset from one person to another. So what we're going to do is I'm going to just talk you through a couple of simple case studies in an effort to see if we can use those to discuss some of those issues. So the first case study concerns Kurt and Amy. Now, they married in 2008. At that time, they were living in New York. Kurt was then working as a banker. In 2010, Kurt became quite interested in blockchain technology and crypto assets because from a political point of view, he was quite a libertarian, had a sort of anti-government, anti-regulation philosophy. And you'll find, certainly from my experience, that many of the people who are particularly interested in cryptocurrencies and the development of them do often have that sort of worldview. In 2011, Kurt told Amy that he'd used some of his annual bonus that he received that year, and he took £25,000 from that, well, dollars it would almost certainly have been, because they were in New York, and bought cryptocurrency from that bonus, including Bitcoin. And that's all that Amy understood at that point. In the following years, Amy knew because he told her that he bought and sold further crypto assets, but in relatively small amounts. In other words, he was dabbling rather than being a big-time investor. So things moved on. In January 2016, they moved to London because of a job transfer. Kurt told Amy that if anything should happen to him, she would find records of all his crypto assets on a USB drive. And there was a copy of that which was kept at his father's home in Cardiff. And in 2017, sadly, their relationship broke down after a violent row. And as Kurt marched out of the flat, he informed Amy that he would be quitting his job. He'd immediately be leaving the country to live in the sun, in his words, and she would never be hearing from him again. So against that background, you find Amy is in your office and is asking for your advice as to what needs to be done. Well, first question is any action required? So having heard that story, you do a little bit of research and start scribbling down some numbers on the back of an envelope, and you note that there was a $25,000 investment. You do a quick Google search. You see that about the time when that investment was made, in February 2011, you could buy a Bitcoin for $1. So $25,000 equals 25,000 Bitcoin. So you do a little bit more research, and at this point it's December 2017 when Amy is consulting you, and you notice that it's actually the point when Bitcoin hits its record high price of around about $20,000 per Bitcoin. So get the calculator out. 25,000 Bitcoin actually equates to $494.5 million. So in the answer to the question, is any action required? Almost certainly yes, because you've got an asset of very substantial value that you need to be thinking about. Just by reference, today, the date I'm recording this at the end of March in 2020, the Bitcoin price has dropped to just over $5,000 per Bitcoin, which still means that that 25,000 Bitcoin holding would be worth in excess of $127 million. So having established that and broken out into a cold sweat, you need to start thinking about what you do next. Well, with assets of that sort of value, particularly being as potentially portable and easy to move as Bitcoin would be, you do need to give some thought to an injunction. Well, an injunction, a freezing order, is of course a in personam order. It prevents the person who has the asset from dealing with it. But just bear in mind some of the difficulties that we've addressed already in relation to cryptocurrencies. The physical freezing of that asset can be quite difficult because, unlike a bank account, if it's not held on any exchange, you are going to struggle to get a third party to prevent any dealings with that asset. If it's held, as we understand in Amy and Kurt's case, purely on USB drives, in other words, he's keeping his private keys in cold storage, the critical thing is to have control of where the private keys are stored themselves, because otherwise those assets can be moved and can be effectively untraceable. So it's very important to think about the terms of the undertaking being perhaps a little broader than you would have in a different sort of case, and it's possibly easier to think of the crypto asset more along the lines of physical assets such as gold coins, and thinking about preserving the actual in specie item where they are stored, rather than thinking about them in the way we think of conventional assets like bank accounts or property in the real property sense, or in the normal investment sense in terms of stocks and shares. So what flows from that is that you probably want to ensure that you preserve not only the cryptocurrency as an intangible asset, but you preserve the physical devices where the items are, where the private keys are stored. Do you just want to preserve one or both? Well, I would suggest you probably want to get both, because you will want to, in due course, examine those, because they will give you potentially a good idea as to not only the holdings that he currently has, but also any other dealing that there has been and any other assets that exist in his control. So preservation of the physical items that you understand the storage is held on is very important. Because that's so important, and particularly in a case such as Kurt and Amy's, where the value of the assets that are held there are potentially very, very large, you should maybe give thought to whether this is one of those rare cases where a search order, an Anton Pillar order, might also be required in order to ensure that you get control of the relevant devices where the passcodes are kept. We all know they're very rare beasts in family proceedings, but the Immerman litigation made it very clear that there was something which family lawyers could use in appropriate cases, as opposed to taking disclosure or taking assets by way of a DIY, a do-it-yourself process. So that certainly is something which you ought to give some consideration to, but of course it has to be proportionate to the case, because Anton Pillar orders to give effect to are complicated and expensive exercises. So it's not something to do casually, but it certainly is something to think about. In most cases where investments are held on an exchange, you may well want to think about serving your, or giving notice of your injunction on relevant exchanges who may hold the assets, as you would do with banks, in where a conventional freezing order is obtained, and indeed you may do it the same with Companies House or with the Land Registry in terms of registering a restriction. So you should give some thought to doing that as well. But of course, one of the problems you face here is that, unlike Companies House, where there is only the one in each jurisdiction, or banks which are usually limited in terms of numbers in each jurisdiction, there are very, very many exchanges which exist for the trading of cryptocurrencies. Some are very large and very popular. Some are relatively small and not used quite as often, but there are lots of them. They are generally virtual in the sense you won't find them in the high street with a branch, and many of them are not going to be UK based. So that creates all sorts of issues that you need to think through in terms of how you give your injunction the most effect that it can. So next thing to think about then is to think about disclosure further down the process, having obtained the injunction. Because of the intangible nature of assets and the fact that they may exist entirely off any conventional recorded mechanism of registration, you will probably want to get possibly a longer series of bank account records for the individual concerned, because you may well see the cash moving out of an account which was then used to purchase investments. And that will help you perhaps give you some idea as to what levels of currency have been bought, which exchanges they've been traded on, and what sort of assets you are potentially dealing with. Likewise, if somebody is dealing with exchanges and you know which exchanges they're dealing with, third-party disclosure order to obtain access of the trading records from those exchanges may also give you a lot of good and useful information about what's available. In the cases such as Kurt and Amy, where you've got USB drives and it seems that that's where most of the holdings have always been recorded, you may well want to get an expert to do a proper analysis of the USB drives to trace what has been on those drives when those files were created, and see if you can tally that with the other information and other documents you have to build up a picture of what assets have been bought at various different times, and indeed what has been disposed of, so you can then think about what's happened to the proceeds of that disposal. Live access to trading platforms being given to an expert is also worth considering. What do I mean by live access? Live access means rather than just printing the ledger sheets or screen prints of a exchange's trading history, actually providing an expert with the passcodes that allows that expert himself or herself to go into the trading platform and analyze what's on there themselves. And certainly in one case we had that order made, the login details for the relevant platforms were provided to the expert, and he was able to then satisfy himself and then in due course us and the court as to what had been going on and what the full picture was. Now, valuation is a problematic area with assets that are as volatile and as unpredictable as Bitcoin and as Ethereum and many of the lesser cryptocurrencies. Bear in mind that the smaller the amount of trading that a particular currency has or a particular token has, the more volatility there will be, caused by the fact that the trading volumes vary only by a small amount, but will have a profound difference in terms of how much trading there is and therefore supply and demand for that particular types of currency. So also think from that the spikes and the troughs may not give a true indication of what the market value of a company, which has had an initial coin offering and has tokens out there from which you are trying to value that company. We'll see in the next case study what I mean by that. But just to give you some examples of just how much movement there has been in different types of token, different types of cryptocurrency. Bitcoin within the last 5 years has varied in price from January 2015 at below $200, which is the low point in the last 5 years, to a 5-year high that we touched on earlier at the back end of 2017 of nearly 20,000. So that's a 101 times increase in value in the space of a 2-year period. The price today is just over $6,200 per Bitcoin. And the other important thing to bear in mind with Bitcoin is that unlike some of the other cryptocurrencies, it has a blockchain which is self-limiting. There are only so many Bitcoin that can be created. The maximum number of Bitcoin that can ever exist is 21 million. The blockchain is designed in such a way that it cannot exceed that number. So that is actually a finite investment, and no doubt one of the reasons why the value of that's been driven, because there will come a point where there cannot be any further Bitcoin generated, and therefore the value of it may well increase a little, as gold and precious metals do, where again there's a limited supply of it. Now, Ethereum is another popular one which you may have heard of. Similarly, last 5 years, we've seen a fluctuating price from between 42 cents up to a high in January 2018 of just over $1,400, so 3,500 times nearly increase in value of that particular asset. That's now fallen back today to a valuation of about $130 per Ethereum. And Ethereum isn't, unlike Bitcoin, is not limited in terms of how many can be issued. And you'll see the number of Ethereum that are being mined, created is increasing. It's about 110 million at the moment. But indeed, Ethereum is less used as a currency, but it is used as a blockchain, which is often used as the platform for the creation of lots of other tokens and cryptocurrencies, which are different in form. So an example of a different type of cryptocurrency such as that is one that I've dealt with in a case. I've just called it X tokens for the purposes of this webinar. But that was a ICO for a particular enterprise that was entered into in November 2018. The low price for it was 0.004. I think it was actually issued in the initial coin offering at a little bit higher than that, so it fell back in price. It then rose to a high of 19 cents per Bitcoin, so per X token, so a significant increase. Today, the value has fallen back to 0.008, so slightly higher now than it was and when it was first issued. And that was an initial coin offering where a fixed number of units were offered, 175 million, so that cannot change. But as we'll see in due course, looking at some charts, that high point valuation and the valuation of the underlying asset was only in a fleeting instant, driven by a particular transaction, which is why it's important, as I say, to look at longer term trends in terms of valuation rather than a single snapshot view at a particular date. So if we look at the Bitcoin price, as I say, over the last 5 or 6 years, you can see how for a long time it had very limited value, bouncing around at just over $1 or so. But then it had a huge spike leading to that peak in 2017 to 18, falling back down again, and then it has sort of peaked and troughed in a less volatile fashion, but still a value that's certainly far from stable. Ethereum, and here is plotted in green against the Bitcoin price in yellow, has had a similar record, but lagging a little bit behind Bitcoin. You can see that Bitcoin was the big explosion in value in 2017 to 18. That created a little bit of a bubble in relation to the value of cryptocurrencies, which Ethereum exploited, and you can see how the value of Ethereum leapt itself on the second wave of enthusiasm later well, very early in 2018, just after the peak in Bitcoin earlier the year before. Now, contrast that to later on the X tokens or other tokens of that nature, as we'll look at when we look at different tokens. So with Kurt and Amy, with the Bitcoin and the volatility in price, certainly what you need to be thinking about is, rather than trying to fix a lump sum on a particular date based on a Bitcoin price, an in-specie division on a Wells and Wells type basis is more likely to be fair. So if there are 100 Bitcoin, 50 Bitcoin going to each of the spouses would more likely be a reasonable assessment, because otherwise there's a danger that from the date when the lump sum is quantified to the date when the Bitcoin are actually realized and the money is generated to allow for the payment to be made, the price may have risen, or worse for the payer, slumped dramatically, even if it's only a day or two later. So an equal sharing of the in-specie asset is more likely to be fair, and then both parties can make their own decisions as to when they liquidate and whether they feel it's worth cashing in or holding onto the assets for longer. But also build into your order where you're receiving Bitcoin the costs of setting up the facilities that will be required in order to hold those Bitcoin or the cryptocurrency. Most people will want to do it by way of an exchange. And if you're receiving Bitcoin into an exchange, there are usually setup costs, which are not insignificant, that the exchange will charge. And there will also be transaction costs in due course for moving the Bitcoin from one exchange to another exchange. So make sure you've identified what those are and build them into your net effect calculations to ensure that the figures are still fair and in accordance with what you intended. And of course, don't forget the incidence of tax, because as a form of property, the government have certainly been very keen to identify them as property, and the HMRC regard them as property which is subject to capital gains tax. So we're going to move on now to a second case study, and this one I've headed the blockchain geek or entrepreneur. This is Alexei and Kate, who married in 2013. In 2017, Alexei was made redundant from his job, at a hedge fund where he'd been quite a high earner. And he then decides that he will spend some of his time pursuing an idea he's had for some time to use blockchain, which he's become enthusiastic about, and to use blockchain technology to speed up cross-border sales of goods and trades of currency and commodities. So using blockchain for a purpose beyond pure akin to currency type assets, but rather as a contractual device, a smart contracting device. So he creates a company, Transborder Trades Limited, which is 100% owned by him, and he organizes in 2018 an initial coin offering of tokens which he calls TBTTs, Transborder Trade Tokens. Akin with most ICOs, the company publishes what's in the trade known as a white paper, which sets out the purpose of the ICO, and it sets out the company's plans for developing the blockchain technology. And you'll find in most ICOs that's exactly what the company does. The white paper is akin to a prospectus on an initial public offering of conventional shares, and it is encouraging investors to buy the tokens, which will provide the company with capital, which it will then be able to use to develop the new technology, and will offer something on the tokens in return. But what that something might be will vary from ICO to ICO, as we'll discuss in a moment. So the ICO takes place in 2018. 200 million TBTTs are created, of which 25 million are issued to investors within the ICO. Only 850 people decide they're going to exploit the offer and take it up. They, between them, buy 22 million TBTTs at the offer price, which is 0.67 pence each. And as a result, they raise a total of £1,474,000 for the company. And that is cash which is received, and they are in turn each given TBTTs in line with their investment. And this is what you'll often see in ICO situations where there's a lot of speculative investment, where people will invest relatively small sums, maybe 500, maybe 1,000, maybe £2,000 into an ICO in the hope that one or two of these may actually turn into something which is valuable. So you can see, if you just take an average there, each of these investors would only have invested about £1,700 each, not large sums by any means. But the sum which the company has received, by contrast, is not insignificant at nearly 1.5 million. So of the shares that haven't been issued, 22 were bought by the investors in the ICO, 178 million remain on the balance sheet. And those you see when you receive disclosure in the divorce case are allocated appear on the balance sheet as company reserve and partner reserve, with a notional value that's akin, that accords to their issue price of 0.67 pence each. Now, Alexei then goes on and develops the business. He finds another investor in early 2019. He transfers 40% of the shares in TBTT to the investor, something of a Dragon's Den type arrangement. That investor then becomes a director, and a shareholders agreement is signed, and in return, further capital is injected into the business for the development of the TBTT project. Also, as part of that, there's a restructuring, which you'll often see, and the TBTTs are transferred to a foundation which is set up in Grand Cayman. And again, that's a feature you may well see in businesses that are in this sector, where they tend to move their assets into jurisdictions that they perceive to be more flexible and perhaps less regulated when it comes to dealing with these unusual crypto assets and the tokens and the securities that they create. What they want to avoid is being categorized as a English company issuing shares which are then regulated through the authorities here. They're trying to ensure that they are as fleet of foot and as unregulated as they can be. Now, the private keys to the various TBTTs that are on the company balance sheet you establish are held on a number of USB drives, at least one of which is actually kept at the family home. They split up in 2019, and again, Kate is seeking advice as to what's to be done about all of this. So a number of issues arise in relation to this. So the first thing is, well, who do those TBTTs belong to? Well, there's no doubt that the ones that have been bought by the investors belong to the investors who have subscribed to them. However, the ones that appear on the company reserve and partner reserve appear to belong to the company. They are company assets, right? Like unissued shares is probably the easiest analogy that you can present to them. And so they are, technically speaking, assets of the company. But in order to understand what they are, you are going to need to understand the white paper and to understand a little bit more about what the actual TBTTs amount to. Sometimes people will think, well, because they're issued a little bit like shares, they are like shares, and that they are therefore a share of the business value. Well, most ICO tokens are not like that. And you need to read the white paper that was presented prior to the ICO to understand what in fact they are. Many ICO issued tokens are more like IOUs. They are an advance purchase for a service which the company is going to provide. But the technology or the product hasn't yet been developed. So it's an IOU which you will be able to act on at some point in the future when there is actually a functioning product. So very many of these tokens are issued on the basis that once the software and the blockchain technology is developed, you will then be able to use your token that you have bought to buy a unit of that product. And indeed, in due course, you'll be able to sell your token to somebody else who wants to use that product. So it has a value, and the value is based on the value of the product that is behind it. So it's important to bear in mind that what appears to be assets on the balance sheet may actually, in some respects, be balanced against the fact that there is a corresponding number of IOUs that the company owes to somebody else who has already invested in the company, which will have to be paid back first, or they'll have first dibs on the product that's produced. So you need to understand all of that from the white paper to try and get a sense of what the value may be and what they amount to. The company reserve and the partner reserve often are used and held there as being TBTTs or tokens, which will be in future be issued either to the shareholders or the directors as a form of reward, or they may well be given to partners who are involved in the development of the business, again, as part of their inducement to become involved in the business. So they are a reserve of tokens which in due course can be issued. Now, are those TBTTs either liquid or available to Alexei? Well, Alexei is a 60% shareholder in the business. So in theory, he's entitled to 60% of the value of the business if it was liquidated. But of course, currently, those tokens are held by the company and are company assets. So you've got the corporate veil between him and the company. Now, the key issue then will be, what value do those tokens have? Well, again, you're going to have to go back to what the white paper proposes. Is there already a product, or is there something of value which these tokens can be used against or not? If nothing has yet been developed, you're talking about something which may have a latent value in the future, but that value hasn't yet arisen. And so that will make valuation very difficult, rather like any startup business where the business may turn into something valuable in the future, but it might just as easily turn out to be nothing at all. So in those circumstances, should you, a little bit like with Kurt and Amy, be thinking about taking any steps to ensure that these tokens, these crypto assets, are preserved by an injunction or by some other means? And if so, how? Well, bear in mind, you've got a company involved here, and the company owns the assets. So if you do seek to make an injunctive application, the company is likely to, first of all, need to be named as a party to it. And the chances are that they may also intervene. And if there are other shareholders, as there are in this example I've given, their interests are likely to be brought to the fore. They are going to intervene to try and ensure that the company's business is not interrupted or interfered with in any way by the injunction that's in place. And that has a particular resonance for somebody like Kate, who, if she does seek that injunction, she will need to give an undertaking, a cross undertaking, in the usual form, to reimburse anyone affected by the freezing order for any financial damage that they have sustained as a result of the order. Now, if the company does indeed fail to be able to continue to trade or fail to exploit opportunities because the tokens aren't free for them to be used, that may have serious ramifications for Kate in due course. So those are issues that you need to really very carefully consider rather than just running into obtaining an injunction, as was possibly appropriate in the case of Kurt and Amy that we discussed earlier. Now, we then have the thorny issue of how do you value TBTT Limited, the company? If it doesn't yet have technology that is developed and ready to run with, then it may have no real value at all, other than a very, very speculative one. But on the other hand, if it already has developed something which is ready to go and can be used, that may be something which is possible to value. But valuation is never going to be easy with a business that is still at an early stage and has possibly a 10% chance of success and a 90% chance of failure, depending on whether the technology works and whether the technology is adopted by anybody who's prepared to pay for it. So again, wells and well sharing may well be something which is more appropriate. But against that, you can have all the arguments where if something is still being developed, that development is happening post-separation, and therefore perhaps should be treated as being post-separation accrual to which the sharing principle should not apply. These are complicated, difficult issues. I'm not trying to give you answers in this webinar, because on any basis it's going to be a case-by-case analysis that you have to do. But these are the sorts of issues you need to be thinking through when you're working through your analysis. So when you're valuing the company, you need to think about whether the TBTT tokens are included in the valuation or not, whether they're a liability in a sense, or whether they're genuinely an asset and what they're worth. You will need to also not forget the fact that nearly £1.5 million was raised in the initial coin offering. Where is that money? Presumably it's still sitting somewhere within the company books. If that money isn't all required in order to develop the product, that may be a source of liquidity within the business, which could be used to pay a lump sum. But again, you're going to need to do some proper exploration of what's going on in the business to properly understand that. And then there's the issue of how do you share any future value, which gives rise to the arguments about post-separation accrual and also Wells and Wells sharing and how you do that, with the particular issues that arise where some of the value won't be held in conventional assets, but may well be held in unconventional crypto assets, with all the difficulties and the unusual aspects and features that those assets have that we discussed earlier. So final point to really think about in that sort of context is the illusion of market capitalization. So here is a share, or rather a token that was issued in an ICO in a case that I dealt with a while ago. You can see that when it was issued, the price initially went up for a while. It then fell back down, and there was very little activity. And you can in fact see that just after issue, there were a number of trades. These are all very low. We're talking about maybe only a dozen or 5 or 6 trades a day at most in these highest peaks. Most of the time, there was no activity in this token at all, because it's not Bitcoin or Ethereum or any of the better known ones. But what you do, of course, notice here around about the middle part, or the summer of 2019, a huge spike where the price went from well below 1 cent per token, or closer to almost zero value, up to beyond 20 cents per token. Now, if you were to take the value of the business at that date as being that value times 175 million tokens that are in circulation, you would come up with a capitalized figure for the business of many tens of billions of pounds. And it's tempting to think, well, that's the way what the business would be valued at that stage, by analogy to the way you would value a company which has publicly traded shares. But of course, that ignores the fact that the reason for that share price, that token rising to that level on that day, is because there was a single trade where somebody had sold a group of tokens to somebody else for a price that was in excess of 20 cents per token. And because that was the last trade, that was what showed the price of that day. But you look at the surrounding period, it was just a one-off. And so you do need to be quite cautious when looking at trading prices and trying to extrapolate from those what a business may be worth, because this is a volatile market with buying and selling and supply and demand driving the price of the share, but not really giving any particular indication as to what an underlying business is worth on the more conventional sense. So these are all the sorts think about having some expert assistance in many, many cases, but you're also going to have to bring to bear on this all the experience that you have of dealing with cases more generally and conventionally, and adapting that to think about these unusual and novel forms of assets that have quite different characteristics, and businesses that have rather different characteristics to those that we are more used to dealing with. So that's where I wind up my section of the talk. Because we're recording this, we don't obviously have the facility to have a question and answer session at the end of it, but you may well have various questions and issues that arise having discussed or watched this. Both Dean and I are available and can be contacted. You've got the contact details on the screen there. We're both also on Twitter and more than happy to engage with you there. And indeed, if we receive enough interesting questions to debate, it may be that we record a further webinar with he and I discussing the answers to some of those issues for your assistance. So thank you very much for your attention. I hope that was useful, and I look forward to seeing you all again soon.